Okay, let's unpack this. We're diving into prime central London PCL, that very exclusive bit of London, Mayfair, Kensington, where a lot of global wealth finds a home.
Right.
And our mission today, really, is to figure out why sellers there are suddenly cutting asking prices quite sharply. It's the biggest drop we've seen in a while, year on year.
It is, and the core issue seems to be policy risk. It's hidden confidence.
So what specific policies or maybe political jitters are making these international buyers think twice?
Well, our sources, including some analysis flagged by Chris Walker, a former Treasury economist, point to one big thing. The government maybe misjudged how non-DOMs would react.
Misjudged. How so?
They seem to rely on a flawed analysis about how easily these wealthy individuals could, move. They thought they'd just take the tax hit.
Ah, but they didn't.
No, the data suggests they're quite elastic, as economists say. They looked at the changes and, well, started looking elsewhere pretty quickly. Places like Italy, maybe?
Okay, let's pin that down. What exactly was the policy shock? What changed with the non-dom rules?
So the old system was a big draw. Non-DOMs didn't pay UK tax on their overseas income or gains, made the UK very attractive.
Right, I remember that.
The new rules, they bring in two massive deterrents, really. First, that tax break. It's now capped at just 4 years.
4 years, okay.
But the kicker, the really critical bit, is that their worldwide assets, everything they own anywhere, could now be hit by UK inheritance tax if they pass away while resident here or soon after leaving.
Wow, okay, that changes the whole picture for someone parking long-term wealth. It's not just income, it's everything.
Exactly. It fundamentally alters the risk calculation, the sense of stability they look for.
And you mentioned competition. Other countries noticed this shift.
Oh, absolutely. Places like Italy, they offer a much simpler deal. An annual flat tax keeps overseas income totally separate. Suddenly looks very appealing, doesn't it?
Yeah, you can see why that would cause a pretty quick reaction.
And the market data shows that reaction quite clearly. It was swift. In the 6 months leading up to May, PCL sales actually dropped 7% compared to the year before.
7%. And buyers.
New prospective buyers registering, that fell by 13%. That's a significant dip in interest.
And that translates into prices, obviously. The average PCL price fell 2.2% in the year to May. You said it was the steepest drop since last August.
That's right. And the quarterly fall, 1.4%, was the biggest quarterly drop in nearly 5 years. It shows the momentum really shifted downwards.
But it's very specific to PCL, isn't it? What about prime outer London, POL?
That's the interesting contrast. PLL relies more on domestic buyers, people needing a home. And there, prices actually rose 1.1% over the same year.
So that really isolates the issue, doesn't it? It strongly suggests PCL's problem is about international confidence, specifically driven by these policy changes, not just a general UK market slump.
Precisely. It pinpoints the impact of that non-DOM reform.
And we should probably mention the stamp duty hike in April, too.
Yeah.
That second home surcharge went up from 3% to 5%. Didn't help, I imagine.
No, it certainly didn't help. It just added another layer of cost, another reason for buyers to hesitate or demand bigger discounts. Kept demand subdued.
So with buyers hesitant and demanding discounts, what are the sellers doing? The ones who really need to sell.
They're getting realistic. They have to. Properties that have been sitting on the market for, say, 6 to 12 months, we're seeing some serious price cuts, sometimes double-digit reductions.
Wow.
It's the market responding directly. Sellers are acknowledging the new reality, the lower risk appetite from those international buyers. Smart buyers might see value now, but they're factoring in that risk premium.
Which brings us to the bigger picture, the sort of political backdrop to all this.
Yeah.
It's not just the non-dom change itself, is it? It's the uncertainty.
Absolutely. Investors hate uncertainty. And with a budget expected, late October, early November, there's a lot of speculation about what might come next regarding wealth taxes.
Yeah, you see conflicting signals. Prime Minister Keir Starmer sounding cautious about taxing our way to growth.
Right. But then you had Deputy PM Angela Rayner's leaked memo reportedly outlining ways to raise taxes, specifically on wealth, to fund growth.
That kind of contradictory messaging must be unnerving for international capital. Policy whiplash, almost.
It definitely creates nervousness. Investors want predictability.
So this puts the Chancellor, Rachel Reeves, in a really tight spot, doesn't it? Trying to balance the books.
Extremely tight. She basically has 3 levers to meet her fiscal rules. Cut spending, raise taxes somewhere, or, loosen the rules themselves.
And doing something like the non-dumb reform, which seems to be actively pushing investment away.
Well, that's the potential flaw, isn't it? If a policy shrinks the tax base you're relying on by driving investment out, it kind of undermines the goal of fiscal stability or growth. It's a tricky balance.
So pulling this together for you listening, the key takeaway seems to be that this PCL price drop isn't random. It's a direct, quite rapid reaction to these specific tax rule changes and the political uncertainty around them.
Yes, it really highlights how quickly legislative shifts can impact these very specific high-value markets. The effect is measurable, almost immediate.
And our sources seem to leave us with a lingering question, something for you to think about. The PCL market's trying to find its feet now, repricing based on this new reality.
The big question hanging over the autumn budget is, will the chancellor introduce something new that interrupts this adjustment process? Or will she let the market continue to find its new, perhaps lower equilibrium? That's the space to watch.